We're gonna let everybody just join. In the meantime, welcome. I am Charlotte. I'm hosting this webinar together with Matt, and we'll wait till we have a little bit more of a quorum in the next 2 minutes. But we're very happy that you guys are here. Thanks for coming. If you feel like it, if you click to meeting tools on the bottom right and go to Q&A, fill out where you're dialing in from. We would love to see where you guys are from. All right. Welcome from Charlotte, from Fort Lauderdale. Okay, let me stop sharing my screen. And Mads, over to you, sharing your screen.
Okay.
All right. Hilton Heads. I mean, Hilton Head is beautiful. What else do we see here?
Dubai.
Welcome. All right. Today, you guys probably joined because you're like, financial model, oh my God, I need to know more about that. So your financial model is one of the most important parts of raising capital, specifically because of the reason that investors are finance people usually. And therefore, they really look closely to your numbers. So it's important as a founder to be able to really know your numbers and show your vision in your numbers as well, in your financial model. So today, I'm Charlotte, founder and CEO of Capwave. I'm teaming up with Matt, one of my really close friends, who is running Lavoie CPA with his team. And we are teaming up with Matt because he knows everything about financial models and has built multiple financial models for founders specifically, especially as they raise capital and as they continue to really track their performance and report back to their investors. So Matt, I will give you the floor to explain who you are.
Sure. I'm Matt DeWald. I'm a CPA in North Carolina and New York. And I'm also a vice president and partner at Lavoie CPA. We'll dive in a little bit on our accounting services in a little bit. But I've known Charlotte here from actually the Charlotte business community for a while. And when we realized that we had some commonalities in terms of the problems we were trying to solve and the messages we're trying to communicate, especially to startups, we said, hey, what a great opportunity for us to get together for a webcast. So here we are and looking forward to the session with you, Charlotte.
Yeah, same. So as I mentioned, maybe not all of you know me, but I'm Charlotte, CEO and founder of Capwave. Capwave was born out of the fact that I've been helping founders raise capital over the last 5-6 years now. We've raised more than $400 million for our founders at my boutique investment bank that I started initially. And then about a year ago, the whole idea of Capwave started. And the idea behind Capwave is that there is a system to raising capital, and it's important that every founder gets the edge. So we close the knowledge gap between what investors see and what founders know when they start their capital raise. And the financial model is a big part of that. Okay, Matt, so we go to the next slide.
Absolutely.
And maybe we skip this one and we just go dive right into the next one. So yeah, for anybody here on the call, For Capwave, we've built 7 agents right now to make you a better capital raiser. That basically means that we've used the formula that we are using in our boutique investment bank to bring that down to every agent to make you a better capital raiser. That is from pitch prep, so you upload your pitch deck and we give you investor grade feedback. We have trained our agents specifically on thousands of decks to make sure that you are in tip-top shape when you send that deck out. Another thing that we do is we match you with the right investors. So we have more than 60,000 investors on our platform that we're tracking on a daily basis. And we basically take the information from your pitch deck and match you to the right investors. So now you know what the curated list of investors is that you should go after and where you should start building those relationships. And then we help you with investor updates and stuff like that to make sure that you know exactly how to speak the investor language, show up with the right materials. That's why we're doing this webinar. And also talk to the right investors for your business so you can close your round much faster. That is for pre-seed, seed, and Series A. If you're raising in the next couple of months, feel free to check it out. I have a QR code here on the bottom right. That's our website. And reach out to us, follow us on socials. We give a lot of information and tips for free on our socials.
Yeah, and speaking of socials, I'll remind you that that's how actually you and I really got connected, Charlotte, was through LinkedIn. You're very prolific on LinkedIn and all the content that you were producing about Capwave. And when I saw what you were doing, I said, let's make sure we connect and understand a little bit more. And it really helped us to kind of come up with some great ideas of how we can help the community.
Yeah, exactly.
So on our end at Lavoie CPA, we provide a variety of fractional CFO and accounting services. So our first and main bucket is what we lovingly call accounting as a service, or AS. So our AS practice, if you will, includes outsourced accounting services, cloud-based software to help build out an accounting infrastructure that is scalable for companies. In our second bucket, we do a lot of strategic items, and this is a bit where we help with clients on budgeting and forecasting, but also helping with reporting, dashboards, CFO support, metrics, and items along those lines. Technology, we help to implement the same softwares that we actually run. So we help clients with ERP, sales and implementations, identifying the right systems for them, optimizing systems, and in evaluating where automation may not currently be used, but could be used in the future. And then finally, we help with other consulting matters such as process improvements, workflow efficiencies, software evaluations, et cetera. In our target audience, again, this is where we saw a lot of overlap with what Charlotte was doing. If you think about the spectrum and timeline of a company, companies will obviously start off with a startup phase where they get initiated and get up and running. They may do some pre-seed initial investments or obtain some initial investments through a pre-seed round, and then start really getting traction when they get through the seed, Series A, B, and C rounds, and further all the way up to IPO. In our client base, we're really targeting the companies that are in that seed to Series B or even Series C rounds, because that's where we're finding that the lower end of the middle market really needs a lot of support and help from a financial and accounting perspective. Now, we do work with some pre-seed level entities, especially where maybe they've been backed up by an investor that knows that they want to get the financial information and infrastructure set from the beginning, so they don't have to think about that again. And that's really where we specialize, is the companies that are really transitioning from that pre-seed into seed series, and really helping them to scale their infrastructure and back office systems to help them grow. Okay. And this slide is really intended to help, again, kind of captivate what's important between Capwave and Lavoie. So maybe one of the phrases that we'd like to say a lot is, we want to start the way you want to finish. And what's critical about that is really thinking long term and putting the right infrastructure in place and thinking about where you are now, but not only about where you are now, but where you want to go. And that's where we thought Capwave's software and infrastructure and systems really helped. So maybe, Charlotte, if you want to dig into that a little bit more, because you really help companies with the way they start.
Yeah. So capital raising is a super overwhelming thing, especially when you're first doing it. And then also the following round. So pre-seed is hard because you don't actually know how to raise the capital, or actually it might be easy because you already know angels that might want to invest. Then seed, you need to do a different thing. And then for Series A, you need to do a different thing. This is all related to your financials in the end. And what we are set out to do as a mission here at Capwave is to make sure that founders become all-around better capital raisers. And one of the reasons we are partnering specifically with partners like Matt is that there are a lot of service providers out there that could help with that. And they also would be really great for you going forward. So maybe you meet Matt when you're raising your pre-seed, and maybe Matt helps you or their firm helps you with your financial model. Then going forward for your seed, they already know you, and therefore they can continue to help you with your financial model for your next raise and also for your Series A, because the financials become more and more important as you go on. So this is one of the reasons why we're working with different service providers. We also have marketing service providers that we work with that is all about brand storytelling and stuff like that. But in the end, the whole mission behind Capwave is to make founders more successful in their capital raise, and that we're closing that knowledge gap. And Matt really helps on the financial side with that.
You know, and one of the, kind of going to the next spot here about frictionless collaboration, one of the things that we pride ourselves with in terms of our client delivery and services is really providing information that helps investors. So not only management, but also the investors to make the right decisions and understand the trajectory of their company. And as you'll see, as we're building out the model, or showing you an example model, it's not only important to have the financial forecasting, but it's also to have the KPI and metric forecasting in your models to help with the communication to investors. That does two things. One, it 100%. Helps you to, it helps with two things. One, it helps to show and demonstrate what are the drivers of the business, right? So if X happens, it leads to more revenues of Y revenues. Having that correlation and understanding really can help then discuss with investors how you're tracking as an organization, but then also internally helping to manage the metrics and helping to drive the results you're aiming for. And then finally, you know, when you're thinking of your forecasting, it's important to think through strategically, how are you guiding not only the company, but then also your future rounds, right? So if you've just raised a seed round and you're heading towards a Series A round, your investors are going to want to know when you're going to be targeting that Series A round and for how much. And that is all part of what you want to include in your forecast and plan, and have open dialogue with your investors throughout that journey. And again, I'll walk through some examples of this, but that collaboration and discussion really helps with setting the strategy for your company and getting the right investors to the plate. Anything to add, Charlotte, on that end?
No, I would love to go to the next slide, because I bet all of you are like, okay, can we get started on a financial model? And I totally understand that. I just want to say one thing here, why it actually matters and why your financial model matters. So a lot of people, especially online, talk about the pitch deck and how the pitch deck is important and it needs to look professional, and it needs to, it's not about being pretty, it's about looking professional and knowing what you're talking about. Your financial model usually comes in after your pitch deck, or that's the one that you show after your pitch deck, but you really need to know your numbers at the time that you're pitching. The only thing though is that if you're pitching the numbers in your pitch deck and during your pitch, and then your financial model is actually not aligned with that, that's a huge red flag. So in order to become a better capital raiser, you need to become more savvy about your numbers. And in order to do so, you need to get some knowledge around how do I actually present my vision and how I think this is going to go and how we're going to market and how we are going to become this larger company and how we're going to scale in our numbers. Because as soon as an investor then sees your financial number and financial model and it all makes sense and everything falls into place, that's when they're like, oh yeah, this founder knows exactly what they're talking about. They have a super clear plan, and I'm going to back the founder not only because of their knowledge, experience, and storytelling. No, now we also see it in the numbers. So that's why it's super important that we go over these financial models so you understand what you're talking about. And we'll go over all the different drivers, because there is a lot of information out there that might not be helpful for you specifically. So we're trying to make this as actionable as possible. So, you know, after you hang out today, this is how I'm going to build it. And this is how I'm going to show that my go-to-market and my skill is actually going to work.
Yep, I think you perfectly nailed the vision plus logic section here on this slide that we were trying to talk about, especially in that communication to investors and third parties. I think the second thing that you want to really think about your financial models then is also using it strategically, right? So again, if you understand what your drivers are and where the business is going and what it's going to result in, that hopefully then creates an easily scalable decision-making model that then helps you to understand, when do you need to hire more employees, what types of employees, and what departments do you need to hire them in. And it helps then to prioritize your initiatives, internal initiatives, to help drive the growth that you're looking for. And again, that should all tie in nicely. The models should tie in nicely then to your communications to your investors, and helping to make sure that then you're using that even internally to help drive and set the strategy for your organization. And then finally, your financial model really does help provide a level of that investor confidence. So I think, Charlotte, you hit upon this perfectly earlier, but it's really critical to using the model to help explaining it to your investors or potential investors, to help ensure that you are showing and locking in your understanding of the business and the metrics that affect you.
Exactly.
Okay. So building a defensible model. So the first thing that we'll do, and this is probably, I think, Charlotte, I know you've probably seen this before. I've seen it a number of times when I've done due diligence for VC, for venture capital firms, is there may be multiple iterations of models that come across. Sometimes you see 3 or 4 different versions of a financial model going into a data room, or getting sent to due diligence providers. And it creates a little bit of confusion, because it shows, or can show, that perhaps the company really hasn't thought through very carefully what their financial model is. And so you really want to make sure you've got one very good locked down version of your financial forecast. And it should be realistic, right? I think some of the worst case scenarios that I've seen are people who just put in a revenue number without really understanding the drivers of that revenue, which gets into the second point here, is to then understand really what are the variable inputs into your model, and making sure you're actually showing your computations. You know, back in second grade, when I was learning long division, the teacher said, show your work. And it's very much the same way even when building a model. Show your work, show what the inputs are, show how they calculate and what the growth rates are, and things like that. So investors can then understand your inputs, and then you're at least having a meaningful conversation with them about your strategy to execution, and not necessarily missing the key points about what your financial model is trying to convey. So that leads really then to the third point here, is again, having drivers that are linked to financial results and performance. A plus B equals C, or P times Q equals X, whatever it is, but showing that math and showing the logic of how you got there. And then obviously, and I think we've reiterated this a few times, but it's showing the how in your numbers and making sure that it ties in nicely into your storyline and into your pitch deck. Anything else on that front, Charlotte?
No, that's great. Okay.
So again, a little bit of reiteration here, but now we're kind of diving a little bit deeper. So what's going to be very important, again, I'll demonstrate this to you in a few minutes, is showing then the impact of your key drivers on revenues. So if you've got a conversion rate, for instance, built into your model, you should be able to change that formula, see the impact on revenues in future periods, and have an updated forecast without much of a problem. Maybe the same thing could be with CAC, cost of acquiring customers, or churn rates if you're in software space. So whatever the key drivers are, you want to make sure that you're talking the right language, having the right inputs into your model that investors are expecting to see. Along with that, you want to make sure that you've got a level of flexibility in your model. So again, you want to be able to show and change inputs into your model, which then show different results. So that way, again, investors, management, and anyone in the organization can understand if we change X or we achieve X% of number of transactions, what's the financial impact? So the computation should be simple and easy to follow and very practical for helping convey to investors. Expense variations. We're spending a lot of time thinking about forecasting your revenues, but let's not forget about the expense side of things. Again, I'll show you a very simple, some examples of that, but your payroll forecast, which for most companies is going to be your number one cost. You want to make sure you've got a very good, well laid out plan of who you're hiring, when you're hiring them, and making sure that your forecast model conveys that in a very simple and conveyable format. If there's any changes in your inputs, and this could be external or otherwise, right? Tariffs as an example. If tariffs or items like that can have a sudden impact on your financial forecast, you want to try to make sure that you're able to layer in those inputs very simple and in a way that can help then show what's the cost and revenue implications accordingly. And then finally, and I see a lot of companies miss this final point, but this is really critical, is making sure that you're reconciling or converting your forecast model into cash. So what that means is thinking through items like working capital. So if, for instance, you're billing customers at the beginning of the month, but you're expecting to not collect cash until the end of the month, you're going to want to make sure that you're showing the impact of your accounts receivable on a cash basis and reconciling that back to your income statement, your forecasted income statement. So you may have the same with accounts payable. If you're carrying inventory, you're going to need to show a level of forecasting and buildup of inventory as you start scaling your business. Whatever that might be, some of those net working capital items should make sure that you're capturing that in your forecast model and building that up and making in order to reconcile back to cash. Anything else that you got there, Charlotte?
No, I think just the more the interlinking here. So just to bring it back, it's super important that you know your drivers, your expense driver, your revenue drivers, your expense drivers, and how you have the different levers that you can toggle. So when an investor asks, for example, why are you raising $1 million? Why are you raising $2 million? That you know exactly the reason why you're doing that, because that's tied back to your model.
Perfect. Yep. Okay, so I think we spoke about defending your projections. So again, strength, I can't think of any better way of describing it than this, right? This strengthens your ability to defend your projections, which enhances credibility with investors. That is what we're after here, is the credibility with investors. Having that level of dynamic forecast then helps to, again, see what happens as business events change, and making sure that you're also capturing the impact of actual results and thinking about the implications on the future. I'll go through that as part of the example as well. Using your model then too as a measure of foresight in mitigation. So you want to be showcasing again your readiness for changes in your business to your investors and also to your management team. And then adaptability, right? Having a level of input to then know exactly what the results are from a financial perspective. By having a good, flexible, dynamic model will help with all of these items, which then helps with your communications internally and externally. Okay. Again, some items that we're trying to help get away from. So what are some mistakes we commonly see? It's not uncommon that I see, a 5-year forecast with 1,000% growth rate, right? Well, what's the basis for that? And so what you want to do is avoid, as we're calling it, fanciful projections, but really hone in on reality in terms of what you think you can achieve and how you're going to get there. Measurable drivers, so price per unit, average sales cycle. So if you've got perhaps, let's say, a long sales cycle between when you meet customers and when you actually close the deal, those might be things that you want to include in your forecast model and even make them as part of your projection analysis. And I can't overemphasize the last point, is there's certainly a preference for simplicity and defendability over complexity and the complicated math. So the more you show your work, the easier it is to see, then the easier it is to have great conversations with investors. Okay, anything else you have there, Charlotte?
No, the only thing, and you will probably show that in the Excel file, is that I would say you might want to have scenarios for yourself, but show just the one scenario that you think is most likely going to happen to the investors. Now, the 1000% is of course crazy, but you also don't want to show very slow growth if you're actually raising capital, because the whole idea behind putting equity capital in your business is that they actually do get a return on that. So there needs to be an idea of the return in your projections already.
Okay, and if you haven't heard this enough already, right, I mentioned P times Q or A plus B equals C. The basic structure here is simple. Show you the inputs, make sure that the logic of how your calculations are working makes sense, and then make sure that it's reflecting correctly in the outputs, which are the summary financial results. And again, we'll in our demo, we'll make sure that you're seeing how all these pieces come together. Okay, and here we go. I'm going to switch over to a live demo, and we'll start showing how the inputs are driven by key assumptions, which generate forecasts. And then what that will do at the end is give us the ability to analyze the results visually to make sure that things make sense. All right. I will switch over now to our model. Okay, so this is an example model. And in this case, we did a 5-year forecast model for a pre-seed company. And we've got several drivers in terms of what was important for them in their business. And you'll see this is like a summary of the forecast model. So we're showing some key KPIs at the top. We'll go into that a little bit later, but these are actually driven from our forecast model itself. And these are important numbers and metrics that the company will be displaying and communicating to investors. We show revenues by different streams, and you'll see how each of these scale separately based on the growth of the business as it goes. And again, we'll show you each of these have different models that build this up, but they're all also interlinked together in order to show how these build. They had some direct expenses that were critical to them, and we've got models that support these amounts. And then we look at operating expenses. And what I think is important is not just to show total personnel costs, but to actually break them down by the functions. So that way, in the future, you're able to quantify and measure who's working on what parts of the company and how that rolls up into your financials. And you'll see that there's, even though we've got some zeros in here, right, we're leaving some placeholders, because one of the things that's really important is to make sure that your forecast model marries up to your chart of accounts in your accounting system, which you're going to want to make sure that you're doing. And again, we'll kind of show this in a little bit. What you want to make sure that you're doing is that your forecast model has the same inputs or line items as your accounting system, so that way you can measure your actuals to forecast very simply and intuitively without having to go through a massive exercise every month when you close the financials. Okay, we reconcile down to EBITDA, which again is an important measure for the investors in this case. Now, in this example, it wasn't important for us to worry about things like depreciation or interest or stock compensation. If that becomes more important in the future, then that's something we can add in and layer on as needed. And if you remember, we talked about reconciling your forecast to cash. So we were adding back any non-cash expenses, any capital expenditures, which again, for this example, we have none, but there may be instances where you do have some and you have a separate forecast for capital expenditures. There were certain commissions. Again, this goes to that net working capital comment I made earlier, that you want to make sure that you're reconciling any net working capital items. In this case, they had an item that was creating an advance payment to some of their of commissions. And so we were making sure we were forecasting the cash impact of that. And then what's the impact of any equity raises? And even these amounts, and I'll show you here in the tabs later, are actually inputs that are coming from the model itself. And then finally, we reconcile to cash, beginning and end of the period for cash and by year. And we also have a separate tab here that breaks us out by month, which I'll show you in a second. But then we can then see, okay, what are the low cash points? How much cash will the company have at each year? And we've got then also the triggering events that are needed in order to make sure that the company has the right funding. So that's on an annual basis. And again, I'm kind of showing this on a summary, but here it is on a monthly basis. So the forecast model breaks everything down as well by month. And all of these inputs, again, are all coming from the revenue transactions. And as you'll see, it's the same exact line items that we saw on the first tab. So again, I'm not trying to scramble up and add things together. Keep it simple, keep it consistent going across. And then where needed, we can see, are there low points in cash? Are there points where maybe the cash goes negative? Because that can help us to determine, again, what's the timing of when we're going to need our next fundraising. And that's an important conversation to have with your current investors, but also your future ones. Okay, I'll pause for a second. Any highlights or thoughts on that, Charlotte, that we should be emphasizing?
Yeah, so for your raise, and it depends a little bit on where you're at, but for your raise, it's going to be super important that you show that month over month and you have an idea of like what those drivers are month over month. And it should probably also be related to how much ad dollars you're spending or how much you're spending on going to certain events or something like that. And it should be probably tied to where you're spending and then seeing that revenue go up or down. Of course, it depends on the revenue drivers of your business. But the main thing here is that you kind of show, okay, so if I turn up the ad spend here, then we should see that in revenue at that moment in time. Or if I go to, if you're not in San Francisco, if I go to San Francisco and I meet with these particular clients, then the sales cycle is usually 6 months. So that's then when we will see that revenue coming in. So it basically tells the story, but in numbers, and it should back up with what you say in your slides or say in person to an investor.
That's right. Okay. So this is the revenue model. I'm going to zoom this out a little bit so we can see this a little bit better. And it's got some, you see that it's got some computations in here and also inputs. I personally like to color the inputs in a separate color so we know exactly what it is. And changing any one of these blue cells will have an impact then on the revenue model and how it calculates. So, and in this case, if you remember, I said this was a pre-seed company, they're just getting launched. And so part of what was important to them was actually the trigger dates of when they thought they could achieve certain milestones of their software development. And that's what these dates represent. So in this case, they thought they can get to a subscription-based model, and it would start on April 1st of 2025. And then here's the inputs that were mattered to them. So it was a $25 per user subscription fee. And when we go down to the software revenue line, this is the $25. So this is the price. And then the quantity, and we'll get into how this gets calculated, is based on a number of advisors. So number of advisors times the recurring revenue equals the amount of monthly revenue to be achieved. Nice and simple. And then this software revenue amount is what then rolls up to the forecast model. I'm off by, oh, here we go. Sorry about that. There we go. So in the month of April, when the revenues are determined to start, we're expecting that they'll start with 100 users at $25 a piece. So the first month of revenue will be $2,500. And that's where that revenue pops up. Very simple calculation. And if we needed to make a change because, okay, maybe technology is running slower, we can then change the date and we'll see that that revenue now will kick out and start here in June. So two key inputs in this time is time, price, and number of units. And so with all of that, we've just been able to dynamically make that change to the model. So let's go to the number of users. This is the inputs that they had for number of advisors in this case. So this is a B2B to C platform. So the company is selling to what they're calling advisors, and advisors are then selling to a number of customers. And what really generates their revenue and revenue growth is achieving a certain number of advisors. And they've had, just kind of helping to paint the story, they've had a very, very good beta product that they've shared with advisors with a lot of enthusiasm, and they've got a nice long wait list. So that's where they've said, okay, we think we can start with 100 advisors. And they think that through word of mouth, going to conferences and other promotional activities, they can quickly get to the number of advisors needed because they think this is a very good solution set that will help them get there. So yeah, we did mention not to have like 5,000% growth year over year, but in this case, they actually think that this is a defensible number of customers and that they can build that out very quickly. And so they've got a story and a timeline for how they're going to do that. But as you see, they also estimate that the growth rate will decrease as time goes on and as their penetration increases. And again, these were all inputs that we can then change in the model very easily. So if it's 1,800%, revenues change, all the calculations, the number of advisors change all throughout the model very quickly and dynamically. They also have an estimate of how much volume each of those investors or those advisors are going to bring to the table on a monthly basis. So we have $3,000 in here, but maybe as time goes on, they start seeing that tracks up. They can change that to 4,000. The whole model changes as a result. And then there's an input in here for an average booking per transaction, which again is an important input for them. And so again, model very easily calculates based on these inputs. Another item that they were looking at doing, so again, the technology stack was going to be building in different phases. So if the first phase, let's say, is the subscription of the software, and the second phase now is having a credit card rebate program. Again, that might require a little bit more technology build and stacking. So let's say they find that this changes due to their expectations. We can change now the revenue model here for the interchange revenue. And we've now pushed out that revenue out here to the month of September. Formulas are very simple. Again, you can see how we built up each of these, all based on the inputs that are above. They know what their interchange revenue fee is going to be. And again, we made that an input, so it's easy to identify. It's not buried within a formula. Very easy to see, and investors can then make the tweaks and changes as they see fit or have meaningful conversation then on each of these inputs. Okay. And then there's a final phase of the build out, and that was what they called an early pay program. So it's basically advancing commissions to some of these advisors. And there's a trigger date now for that, because then again, that's a third technology stack solution that they're needing to build. And we then looked at, well, what's the user adoption, right? What's the commissionable portion of that gross booking that we expect them to be using? What's the commission rate? And we started building out the inputs in order to determine how much interest they would charge and how much revenue all this would lead to. And now the company can have meaningful conversations with investors on any of these inputs, and not have to worry about the quabbling about all the details, but instead really focus on what's the timing, because that's probably the biggest input here. what's the timing of when they expected to have this come across. Any highlights or questions or thoughts that I should be emphasizing again here, Charlotte?
I think the main thing being that so what we just discussed is like your revenue assumptions. So what are the assumptions when things are going to go into market? What does that result into? And you might just start with one thing and maybe your pricing will change. So this is very specific for this particular company that has multiple different features launching that have a different type of revenue model, and therefore you see all these line items. You might say, hey, we start with X amount of features and it will be a bit cheaper, but then in a year from now, we're planning to increase our prices. And that's then a way for you also to show. So you can, again, like show, okay, by that time, we will make X amount more because now it's linked to this. The most important thing here is that it's easy to have a discussion with investors because it's not hidden in the formulas. Now you have one place where you can show what assumptions you've been making on your revenue drivers.
That's right. Next, go to staffing. Staffing, I think, is important because, again, it's going to be the most likely, it's going to be the biggest cost the company has. And I've seen VCs really hone in on and really drill in on management and ask the question, who's going to be your first 10 hires? Because your first 10 hires really are the ones that then establish and set the precedent for the company going forward. So they are very carefully evaluating the people, the qualifications, the roles that they're going to be playing and things like that. So what I find is it's important to then have a well-conveyed hiring plan. So in this case, we kept it very simple, but it's what we want to do. And I think if you remember in the first tab, we broke the team members down by different categories: general, administrative, technology, and sales and marketing. And you'll see that we've got that conveyed here in this column. And this is this model is driven by several inputs. Again, you see all the inputs laid out very carefully. So start with the CEO, John Smith. He's on the team of G&A. We have an annual salary of $175,000. For the sake of this case, we actually put in a multiplier. So let's say we wanted 2 CEOs, you could put in 2, and it would change the results. And then a start date. So this is really now laying out the future forecast of hires and by dates and when we think we can reasonably achieve to bring them in. So we've laid out each of the different roles and functions, when they plan on starting, and then the model just simply picks up the cost of them from that start date going forward. So did the same for their technology team, each with different hire dates. Again, if we wanted to change this so there's 2 or 3 people that got hired at the same time, you can change that, and it changes the calculation pretty simply, and it rolls it all the way up to the model and through the income statement. This is an area that's always critical, is what's your sales and marketing efforts? Who are you going to be hiring? What's the positions? And how are you going to fill out that sales and marketing team, and building that out too. Now, in this case, we also built in a sales commission model, right? So based on the sales that the company generates, we're saying, hey, you know what? There may be a level of sales commissions that need to be paid out. And we've got that built in and connected over here from the revenue tab. So down here, we've got commission rate per salesperson, 10%, and that is being calculated right here, commission expense paid to sales team. And in this case, it was a percentage of the software costs. And then that commission is feeding into our compensation. And we want to make sure that we're showing that as a sales and marketing cost. And so then it now feeds up into the income statement like that. Another input, again, it's not, it can be overly overlooked, but payroll related costs. I generally see 10 to 20%. I think in general, it's about 15%. And this covers things like FICA, health insurance, and other items. Varies by company to company. But to have that level, to have this input, I think is also important, again, to making sure that you're not forgetting any cost structure related to employees. I do have one VC I work closely with, and this is an important metric for them. They want to see what's the head count by person, by department, by month and year. So I've built that into all of my models. So that way we can see, okay, where are they going to be spending their money from a personnel perspective over time? Then you see that it starts with G&A in this case, and then we start seeing that sales starts picking up and technology starts picking up. And having that level of headcount also helps to convey to investors what you're planning on doing, and also should tie very nicely into your use of funds. One of the main data points that you'll have in your slide deck is, what are you planning on doing? If you raise, let's say, $1 million for your startup, you'll need to explain where you're going to be spending that money. Well, you want to make sure that your headcount is then tying into that message, into your forecast, and then also into your slide deck. Okay. Anything else on a personnel standpoint, Charlotte?
I would say, like, really think about these assumptions and like who you need, because the most important thing is that an investor gets the idea that you know exactly how to plan for your scale, and that you have an idea of like how much people can actually handle, and think about those ratios. I see that there's a question also about the ratios of like headcount and cost, expense, and revenue. We'll dive into that a little bit later, but it's important that you have an idea of like, okay, if I have one salesperson, how many deals can that person actually do in a year? And then what does that mean for our growth? Just to have a better idea, because the thing is that people and your team are actually usually the ones that scale your company, together with, of course, great software if you build software, but you cannot do it without the people. So it's super important that you have an idea of like, who do I need next year? Who do I need the year after that? And how do we grow that way?
Yeah, that brings up 2 points in my mind. You know, I deal with a lot of B2B software companies, and the 2 things I always look out for are, one, what does it take to implement that software? Because then do you need client delivery people in order to implement the software into your customers? So what's the hiring plan in order to match the revenues for that? And number 2, any customer success managers, CSMs, that are required in order to stabilize and keep your client base happy, because you want to have a good ratio of CSMs to clients to make sure you're not overworking your client service managers. Okay. Again, I'm actually going to put fundraising last. Sorry about that. So we're looking here at a couple other cost structures, contractors and professional fees. So I build out a very simple, similar model as what we saw for payroll, but it's a little bit simpler for any contractors. And I like to differentiate between contractors and employees, because employees obviously have a headcount cost. You know, in the US anyway, they've got payroll related costs, and we want to make sure we're separating that. I also find that investors really do want to know what is your actual FTEs, your full-time equivalents, versus contractors, and keep them separated. And then it also helps with your cost structure, right? You may have, let's say, as you see here, we may have lower monthly costs because we're dealing with, in this case, let's say a senior software engineer who's working part-time. So the level of cost related to a full-time versus part-time may be quite different. And so I try to bring out and break out those fees separate from employees. And then professional fees. There may be other professional fees, you know, maybe fractional CFOs or SOC 1 providers, marketing. We've got a marketing designer, website maintenance, whatever it may be. But we like to put in some of those costs, again, separate from employees, and to help build that into the model with all the same inputs, right? You change the amount and dates, and the model then picks that up and carries it all the way through. Same with software costs. Again, I deal with a lot of software companies, but really anyone in any business is going to have a level of software costs. So it's just good to have that modeled out and figured into your forecast model. And you'll see, again, same inputs, start dates, monthly costs, and then scheduling it out and building it into your model. If you feel so inclined, I do think it is a good idea is to also forecast it by department. So that way, in case you need to analyze your carrying cost by department, then at least you have that information available. And then finally, we talked about this earlier, but this is the trigger dates and amounts for your fundraising. The investors are interested in your current round, but they also want to know where you're heading and what's it going to look like as you go through multiple rounds, and so that way they can even forecast the level of dilution that they're going to be experiencing, and what's the growth trajectory of the company, and again, what are the proceeds and future raises going to do. And so the more you're thinking about that now, the more your story is going to be complete, and you've got now a better message for your investors. So in here, we've put in amounts and dates of when we think that we'll achieve each of those funding raises, which all of these are drivers and inputs that come into the forecast model here as the equity pickups. So as I change a date in one, it changes the month that it hits, and then it rolls up into the monthly forecast or to the annual forecast. Charlotte, anything to add to this discussion?
No, I think we have some questions. Have we gone through all the tabs by now?
We have, yes.
Okay. So let's do some questions.
Awesome.
So the first one we got was from Hector, who has built a fully functional MVP. And his question is, could bringing on a strategic co-founder enhance our credibility, streamline fundraising, or sharpen our financial model, or is sharpening our financial model more important? My answer there is that it's always great to have a strategic co-founder, because for investors to only bet on one person is hard, because it's kind of risky. It does depend though on the traction that you have with your model, and like, is your MVP so great already and you already have traction, meaning revenue, then you might be able to go out to raise and get that strategic person later on.
I agree with you.
Yeah. Anything to add there, Matt?
No, I at that message that I hear all the time from that one VC I work with, they say, focus on your first 10 hires and get the right people in right from the get-go. And that they will say that even to the companies they don't fund. And that I think having the right people on board is so key. Yeah,
I agree. So Hector, I hope that answered your question. Feel free to add another question if you have any other questions. All right. Denise said, does Capwave include built-in benchmarks? So that is for SaaS revenue per FTE, expense ratios, headcount models, et cetera, et cetera. We have it on the roadmap. It's currently not in there yet, but yes, we will. How we're currently doing it is kind of like, we have a Slack community. So anybody that's a growth user becomes part of the Slack community, and we give you benchmarks there from a valuation perspective, also financial modeling. You get access to these exclusive webinars. And when you work with somebody like Matt, he can give you a better idea of like, this is what a good model looks like, and like what a good assumption looks like versus what is not realistic. Anything to add there, Matt?
Nope. I think you said that beautifully.
Okay, great. Then Wes, how do you build in changes in a driver in outer years? For instance, if CAC is $25 in years 1 to 3, but higher in years 4 to 7, how do you factor that in? Any way to make it dynamic by year and its impact on revenue? Do you want to show it in the Excel file?
I will, because it's actually already built into my existing. Now, I didn't use that in particular, but it's the same concept. I would use a trigger date. So I would use the same. So I'm using it here in the revenue side. I'm using trigger dates. That basically says if the sale is greater than this amount, then do this. I would use trigger dates for something like CAC. I would have it look. I would have the formulas based on the months and the event date that you want to change that CAC. So if you said, all right, starting in 1/1/2026, let's increase the CAC to $25. I would have the formula look for that date and say any date that's greater than this, use that CAC. You can use an if formula or an index or anything like that in Excel to do that. That's how I would do it. Make it an input.
Okay, and then would you add like multiple of those in case you feel like,
Yeah, if you think it's relevant, absolutely. So if you think there's going to be more competition in your space and you think your CAC is going to go up, and I think that's in general what happens, right? Earlier, maybe you can have, well, it could go the other way, either way, right? You could have a higher CAC at the beginning because you're trying to find that audience, trying to get traction, and then your CAC goes down. Or it could be you're expecting more competition, or maybe you're in Facebook ads, which can get very competitive in election years, as an example. The CAC rate may go up because it's an election year, and you'll want to build that in your model. Absolutely, I would put that in and use a date triggered mechanism for it.
Yeah, and then Matt, do you want to explain what CAC actually is for the rest of the audience?
Sorry, yes, it's the cost of acquiring a customer. So in essence, what does it cost you to attain each customer? And when you're making that formula, it's the numerator is your sales and marketing costs, and it's divided by the number of customers that you're achieving with those costs.
Okay, Wes, I hope that answered your question. And this actually goes right into Lana's question. Where do you factor in assumptions for marketing expenses and lead costs?
So I would break that down into different pieces. So lead cost may be transactional. Maybe you're hiring a consulting firm or an agency to help identify leads, and maybe you've got a rate per lead, 5-10 cents per lead or whatever it may be. I would be building that into your revenue model, so that way your leads are generating a number of conversions, which then turn into a number of paying customers, and I would just follow through the logic and calculations. I would put that calculation in the revenue model and have it rolling up to your sales and marketing expenses on your summary. So similar to what I did here with commissions, right? So even though the commission expense is not revenue, since I have the revenue calculated and summarized in the revenue model, I put the commission expense here, and then I had it roll up into the, in this case, the payroll expense.
Okay, I agree. Yeah, I would just add different rows to that. So, and then you probably also want to have an assumption there of like maybe the leads in the beginning are more or less expensive, and then the bigger you grow, they become more or less expensive depending on how your audience shrinks or actually expands.
Absolutely. That goes then back to the table we were talking about and having an indexing. Mm-hmm.
Yeah, exactly. All right, let me see the next one. Denise, from your experience, how do you recommend founders account for the varied pacing of software rollout, pre-implementation costs, onboarding, and revenue payment timing? Do you typically suggest applying a pacing model to smooth this, or is that a level of detail not something investors focus on yet?
I'd say that depends where in your life cycle the business is. So if you're pre-seed and you're still kind of raising money on an idea, I think they're probably more interested in your strategy and your product development cycle. Now, your model does need to tie into that, but I think they're going to be less critical of each of those tiny little dates in between, and more interested in when you're going to get first dollar of revenue. So I think that that's what I would hone in on. I would not try to get overly complex, but I try to put in, again, reasonable assumptions that then can be triggered by dates and making sure it's tying in with your communications with investors. What do you think?
Yeah, I think it depends. In the end, you just need to show when you think revenue will be coming in. I think it's important that you have, so if you're a SaaS platform, for example, it's important that you show like, hey, this is what we will have as MRR, and the ARR is just basically your MRR times 12. and that you're really having an idea about your churn and you know exactly how that is all going to go. Yeah, it's important for your cash though to have an understanding of like, when does the revenue come in? If you do need to show your cash in your model, because that's the most important part, and that's how an investor gets comfortable with like, okay, so this is how much runway you will have. How the software rollout will be, this will all be in your model, but I don't think you have to smooth it out. You have to just be very clear on like, hey, we're running pilots from January through April with these 5 clients, and we expect 3 of them to convert into paid clients, and that then will happen in May, and that's when the revenue will come in, for example. So that tells the story in your numbers.
Exactly. That's right. And you don't want to overly complicate that. Yeah.
Exactly. Yeah. So I wouldn't smooth it, I guess.
Yeah.
All right. Then Catherine said, do you mind sharing the cell formula that allows you to populate your races on their trigger dates?
Sure. So this is the funding raise amounts, and this is all date driven. So it's a long formula, but yeah, so it's looking at the forecast tab, or the fundraising tab, sorry, and it's bouncing it off the dates up here. So I'm saying if the date here on this table in the month end date agrees to what's in the fundraising tab, then pull in the fundraising amount. So I just use the end of date amounts, end of month dates in order to trigger the amounts.
Okay, hope that
I will confess, I am barely even a medium level Excel whiz. I am not. There are people who blow me away. I am not great at Excel, but I'm very good at my logic. So I make sure that my logic is what comes across in my calculations.
Yeah, no, that's great, man. And maybe we can share that offline as well as like part of the follow-up email.
Okay.
I also just chatted to you guys, like if you have any questions after this, we have still half an hour to go though, but if you have any questions after this, feel free to connect with us on LinkedIn and message us, because we're here to answer any of your questions. Okay. Here we have a question. We are in one market today in the UAE and raising per market. We have just launched 3 additional markets, but are raising per country. We are showcasing a total TAM in all 30 markets where we want to be. What is the best way to showcase this under revenues?
Complicated. You're already going international from day one. Exciting, first off. Wow, you're already getting into a moderate level complexity is the first thing I will say, right? So with that, I think it's important to model each region separately, because each of them may have different drivers and different growth rates depending on your product or services. So I would do a model for each one and have them roll up. Now, one of the issues you may have, or probably will have, is also foreign currency. If you're in the UAE and you now have a subsidiary in Germany, let's say, and your Germany operates in euros, and you have another subsidiary in the US, which is obviously USD, you're going to have translation variances that I think you're going to want to include in your forecast model. And I would include those currency differences or as an input as well into your model. So include a translation rate into your forecast model, and then I would build them up individually and then roll them up together into one. That'd be my general approach to that.
Yeah, I agree with that, because also you probably have different expenses in different markets. So it's important to show that you know those expenses and that you have an idea of that, and indeed like roll it then up. And also like hopefully understanding that potentially after launching a lot of different markets, especially 30 markets, like hopefully you can rinse and repeat some of the stuff that you've done. So especially for the US, and like have a big strategy, by the way, on why you're unlocking different markets and that it all makes sense because of XYZ. But for example, in the US, it's probably much easier to unlock different states if that's what you want to do than just going to Europe where you have to change all the language and all of that. So think about that and have like a great plan around that, and then show that also in your model that potentially the cost launching in the US might be cheaper or not than launching in Europe and all the different countries there with all their different regulations.
Yeah, and if you're at that level of complexity in your business, I would also suggest at that point you probably should be getting into more sophisticated forecasting software than just Excel, because that's going to get very unwieldy very quickly. So if you're really at that level of scale that quick already, I would not be trying to do all that in Excel.
Do you have any recommendations for the software?
I will tell you, I mean, there's some pretty good medium-sized software. Adaptive is a very strong software product. Vena is another software that might be good. I will say this, for that 10 to $100 million revenue size company, I find that the software solutions are difficult to find and use for forecasting purposes. Just my experience. I also have a very high threshold of what I want out of software providers. When you start getting into the enterprise level, that's when you can get much better solutions, but you're looking at a big cost to get them up and running and maintained.
Yeah, I just saw that they're seed stage year 2. The founder on a call is Tristan, and he was asking this question. So Tristan, let us know if that answered your question. If you have any other questions regarding software or anything, feel free to reach out. All right, then Ed is asking, is Capwave useful for non-B2B software startups, for example, hard tech? Yes, still, of course, important. I would say that our focus has been on tech startups mostly, meaning like software startups, but we do have our models also trained on anything else. So yes, you could still find a lot of use in using Capwave. All right, then the next question is regarding the solo founder question, what level of traction is expected if all products are fully functional? And how is it viewed if employees hold equity pre-seed? Solo founder, what is hard about being a solo founder is that the investor is basically betting on you because you have most of the skin in the game. You have most of the upsides when this company really goes well. But also you're the only person that is really there with the idea and that is running the business. Now, if you build like a really strong team around you and indeed all your employees have equity, that means that they have skin in the game as well. In order for this company to go well, that's actually in their interest. That's what that means. The most important thing is that you then convince the investor that, hey, it's not just me. I have all these other people that are super motivated as well. Maybe they're not co-founders, but they are early employees that have a chunk of equity. And therefore, with that skin in the game, you can convince the investor it's not just me. Regarding traction is your lever and your push basically to tell an investor, I have demand, the product is working, and you should invest simply because the business is already going somewhere. The reason why raising as a solo founder without traction is really hard is because of the fact that an investor doesn't have the conviction yet that what you're building actually is needed in the market and you will find that product market fit. Anything to add there, Matt?
I think one question to ask if you're in that situation too is that if you can't find employees, then how do you expect to find customers? And that is a question that I would expect to receive from an investor. Yep.
Yeah, I think one of the things that when I invest myself, so I'm quite an active angel. When I invest myself, I really look at, does the founder have a secret sauce? Like, do they know the market so well? Do they know where the customers are? Do they already have distribution? And then if they don't have a co-founder, I'm like, okay, how strong is the team that they have next to them and how much can they do themselves versus where they really need the team? Of course, you will always need a team because you cannot build a $1 billion company by yourself. But the most important thing being like, if it's a software product, does the founder also have software expertise? Like, could they fix it if something is wrong or not? Or are they fully relying now on an external software development shop? Because that might be tricky. So it all depends a little bit on how you have your story around your team and how you're building your team and who is already invested in you as well. Because I will also look at the cap table, who has been on the cap table and can actually help with making this company a success. I hope that answers your question.
I've seen companies get investment dollars because of the team and the team members, even more than their ability to communicate the story, believe it or not. They believed or had seen traction from the founders and the founding team. And there was already credits or they scored points already just because of who they were and their prior experiences of having successful exits. So I think that the team may actually arguably be more important than the product in some cases. Not all cases, but some cases.
Yeah, definitely in pre-seed, because in pre-seed, you're basically betting on the people being able to do what they say they're going to do. Yeah, 100%. All right, I don't think we have any other questions. So with that, Matt, shall we talk a little bit about how to get in contact with you? What's next? What are next steps?
Yeah, I can actually, and I don't want to dive too much into details, but I do think it's worth illustrating. I did talk about having actuals versus forecasts and being able to marry up the results and making that a plug and play. So I actually have a separate example that I can show where we've done that. So just, you know, since we have the time, I might as well share that for a minute here. The concept is very simple, but the importance of this is huge because, again, I've seen instances where companies weren't doing this. They had a financial forecast over here, they had actuals over here, and they never married the two up together. And then it becomes very hard to say, well, how'd you actually do? And you want to keep this maintained as time goes on. So in this case, totally different company. They have a number of visits that then drives their revenue and net revenue. They had contractual adjustments. They had, you know, like a reimbursement agreement, which then was a contractual adjustment we tracked. Cost of sales per visit, gross profit per visit. But here's the important thing. It's going along the top. You see that we had, this is from the accounting system itself. We had the actuals by month dropped into the forecast. And then that was up through March in this example. And then starting in April is when we had the forecast model picking up. And this was very easy for us to drop in from the accounting system, the actual results, in order to keep this model updated and refreshed as time went on. So that way, all in one place, investors could see, here is our actuals and how we progressed, and how does that benchmark and show against our forecast to make sure that things are in alignment. So again, if you're already past that pre-seed round, or even your seed round, and you're aiming towards Series A, you really want to be making sure that your historical financial information is aligning and shown in a way that presents up against your forecasts. And then on the summary of forecast for the year, you'll see that 2024, we actually have the actuals for the year. And then 2025, we had 3 months of actuals, 9 months of forecast, made it very clear to investors as to what they were looking at, and then they could see the details in the other underlying tabs. And in this model, it's all very much the same. You'll see that I've got the same basic template for each of the tabs we saw in the other example. That's why I'm not going to go and dive into details on it, but you'll see that there's consistency in terms of how I build those models, so that way I can really hone in on what's important to the business, which is understanding the revenue drivers and growth. So figured I just put that out there because I think that's an item that often gets lost, and it makes it very difficult for investors to trust the financial information that they're seeing if the actuals are not presented.
So what do you recommend for founders to kind of like, what kind of systems do they need to get into place from a pre-seed and then all the way to seed and then to Series A to be able to track all this and show that investor confidence?
Yeah, let me start with this, right? In the very early stages, you certainly can operate, you know, and your business is really simple and maybe you're not even generating revenues. You could probably be using QuickBooks to at least start tracking your costs and to start understanding your cost structure. When you start getting to the point, though, of turning on revenues and you're expecting revenues to come in fast, if you think at all QuickBooks isn't going to be able to handle your volume, start making that migration sooner than later. Don't wait for the wheels to fall off your accounting systems before you turn around and say, oh, I should have done this a while ago. This goes back to where we said, start the way you want to finish. So almost all the clients we bring in, we almost all of them, I'll say 9 out of 10, maybe even 19 out of 20, we are migrating them out of QuickBooks and getting them to scalable solutions. And the system that we use the most is Sage Intacct. It is great across multiple industries, bringing in data points that we're seeing here. The KPIs that you saw in the examples I was showing you, actually, we've got those built right into Sage Intacct, right? So the ability to bring in non-financial information into your accounting system to then do reporting makes life a whole lot easier, and you're not then trying to scramble and pull together 10 different pieces of information to present to investors. It's all in one place. So that's the Swiss Army knife that we've gone to and used the most from an accounting perspective. And again, if we pick up any seed or pre-seed companies, we're usually migrating them straight in because we want them to never have to worry about their accounting system again for as long as they're working with us. So that's very much the mentality we have. Start the way you want to finish.
I like that. That's awesome. Any other tips, tricks, like what do you see often as like big mistakes that founders make when they start working with you guys outside of like maybe using QuickBooks or anything else? And by the way, don't overspend on your accounting software from the get-go. There's no point. There will be a good inflection point where you can swap it over.
That's right. That's exactly right. When you get serious, or you have a serious investor at the table, that's usually the time to make the change in accounting systems. It's not while you're still kind of figuring out your ideas and kind of ideating. I think the biggest mistake that we see is, well, and this is hard, right? You know, what we are selling at the end of the day is trust. And the trust we sell is conveyed through accounting services and solutions. Right. You know, our clients are handing over banking information to us, and we're running their accounts payable for them and invoicing their customers. So there's a lot of trust that's really required, and we hold ourselves to a high standard in that regard. One element of the trust, though, is we know how to automate things. We know how to simplify and scale things. That's what we do. We take pre-seed companies that have no revenue, and now here we are a year and a half later, and they're generating $250,000 a month of revenue, and they're piling all that into our accounting systems. And we close the books the same way we did when they were just getting started. So as part of the trust, it's understanding we know what we're doing, and we know how to build out for that infrastructure. And there are times where clients are like, well, if I don't use this system or this system, tell me what the price is. And it's like, no. You're asking me to run a marathon without shoes on. We know what the infrastructure is required in order to get you where you need to go. So while I can't say just trust us, at the end of the day, it's the relationships that don't work are the ones where there isn't that trust. And so we're very careful about now identifying and working with customers who do trust us and will work with us in that regard and help us to get them where they want to be, because we know how to do it.
Yeah, no, that makes sense. And then from do you ever do just building financial models or not at all?
Occasionally we do. I'd say it's not common, but we do. So we work with, I mentioned earlier, a VC firm that works B2B software companies specifically. And a lot of them come to us with models that don't make sense. And the VC is very interested in making an investment, but they can't do it on the basis of the model that they have. So they may engage us to help with reconstructing a model. There's other instances, again, I'll say friends of the firm, people that we know who we work closely with, and they've got a really big idea and we'll help them build out their model. So we do that for certain. And we like doing it because it's actually fun work. And we like learning about where companies are going to go and what they want to do. And it helps to build, our network of people, and again, helps to establish trust in the community. So yes, we do it.
Yes. Okay, great. I guess let's go into then how can the people that have been on this call learn more about Lavoie, learn more about how to build this financial model, because we've gone over it, but there's still a lot of nuance to it. And it's not easy to do that just within the 90 minutes that we have here today. We might still have some slides there, do we?
We do. So I'm actually bringing that up. Glad you said that. Let's see if this comes across.
And by the way, guys, if you have any other questions, feel free to put it in the Q&A. We'll still cover those.
Yeah. So two ways. So I've included Shari Lavoie, who's our founder and CEO. She's the one who brought up Lavoie CPA from nothing in 2009, so 16 years ago to today. And so we've gone through the same exercise that we're talking about in terms of forecasting and all that. Now, while we don't bring in investor dollars, just because of the nature of our services and firm, we've gone through that startup journey ourselves. So we do this and say everything that we do from a level of experience or in terms of what we do every day. So Shari, who I've got her contact information on here, and you see mine as well via email. LinkedIn is also fantastic. We're very active in LinkedIn, both from our corporate page, but then individually, Shari and I are very active in LinkedIn. So that's how you can find us.
Okay, that's great. And then is there anything that you will be willing to share with the group afterwards, like in an email and a follow-up email?
Yes, I'd say reach out to me first, because what I'd be cautious about is sending out a forecast model without understanding context. I know you can go out and buy forecast models and templates. I've seen those. I've interacted with them. I frankly think they're terrible. Maybe it's just my personal preference for simplicity. With that in mind, I find that if you just give someone a blanket model, it may not necessarily help them. But if we understand better and have a dialogue about what they're looking for, then maybe we can help them. So I'd say first, let's start a dialogue, right? This is intended to be a means for us to get to know the community better, understand your audience better. You get to understand ours better. And so to be collaborative. So I'd say just reach out and let's have a dialogue and see where we go from there.
I agree with that. So, and I would echo that just standard models don't always work, particularly because your business might be very different from a driver perspective. And it's super important to show that you know your drivers in your financial model. So it's good to have that first conversation so you can set up those assumptions really well and it all makes sense. It's like the same as what Matt has showed today. There was no cost per lead or anything like that they actually had to input there, because that was not an assumption they needed to make. For another type business, you might. So if ad dollars is like very important for you, you might want to have a cost per lead. Or if you have a different style of like growing your team, or like you doing events or something like that, and your go-to-market just is very different, you want to make sure that you have all those drivers in there. So just having a conversation with a professional like Matt is super helpful to really get there and make sure that all those drivers are in there.
Yeah. When I'm working through and helping someone build their first model, I probably spend 2 to 1 hours, 2 hours understanding the business, talking to them, understanding how it works, and to 1 hour building the actual model. And it's because it's really important to understand what's that pipeline of activity, what's that funnel. of activity that gets you down to the revenues. And that varies by every company and industry.
Yeah, exactly. Okay. Well, then lastly about Capwave, again, we're here to help founders become better capital raisers and basically close that knowledge gap at every stage between what investors see, because investors see hundreds of pitches every single month, and a founder is just starting to pitch for the next stage. What we're really focused on right now is to help founders at every stage, pre-seed, seed, and Series A. At pre-seed, we have specific master classes to really help you understand what an investor is expecting at pre-seed. For seed, we have the same. What is an investor expecting at seed from a financial traction perspective, what you need to show in your data room. And then the same for Series A, because there is a huge difference between all of those. And how we're tying that all together is by actually automating your investor updates as well. Because the only way to really build those relationships early and know exactly who is going to invest in your next stage, in your next round, is by keeping them up to date and building those relationships super early. So what we're doing, for example, for Capwave is, I mean, I've been in this industry for a really long time, but I already know who is going to invest in our seed, who is going to invest in our Series A, and I keep them posted through Capwave by basically saying, okay, this is where we're going, this is the amount of revenue we have today, this is what we've learned, and these are the features we're building. So now an investor already knows and gets to know me and sees all the different updates, similar to how it is on LinkedIn and how you can do posts, but now it's your investor hub on Capwave, where now an investor can really track us and see us, and we stay top of mind. So when we go out to market to really raise our next round, we already know who is going to be interested in our round. I would stress this really, really hard. Capital raising for your whole startup journey is a system, and it's not a one and done. So just be very clear on that. Unfortunately, it's not like, oh, I go out to raise and like it's just going to be easy. No, it's about trust building, similar to your numbers trust building. It's also about trust building that you're really, learning from the market, finding product market fit, showing that in your financials, and kind of like going all the way through to maybe you need to even a Series B, C, and whatever else. But there is different expectations at different stages, and we help founders become better capital raisers at any stage.
Charlotte, to anyone who is not already following you on LinkedIn, I think the first thing I'm going to tell them to do is follow you on LinkedIn, because you provide excellent comments and commentary every time. And I get so much value just reading what you have to write. And what you just hit on is so on target and so overlooked. I hear a lot of founders say, as all I need is one round, and then I'll never need another round again. And what they miss from that is, well, what's the incentive then for their investors? What's the liquidity event that's going to get them to the exit that they're ultimately looking for? And it's that knowledge and that communication and what you convey in LinkedIn and anytime anyone interacts with you that you are just oozing with. So thank you for that, because what you just said is just so critical for anyone and any entrepreneurs to understand.
Yeah. And on top of that, everybody can become a great capital raiser. You just need to get the right tools, and that's what we're building with Capwave. So check us out. If you're not raising right now, follow us. You will get a lot of information out of that, and do the same with Matt, because Matt knows a lot about this, and actually building the right systems is going to be super important for you to be scalable. So thank you, all of you, for being here today. And I hope you have a great rest of your day. We'll follow up with some other information, and follow us on socials.
Yes. Thanks, Charlotte. Great job.
Thank you. Bye-bye.